if you all have some initial questions, feel free to put them in the chat as well, so that way we can get to them right afterwards. Now, traditionally, Dr. Khaled would be on here to introduce myself. However, I believe that he and his team may be running a little bit late. So if they're not on, I will go ahead and start. But I think there's Katya. Okay. Okay, great.
Welcome, everybody. So I'd like to introduce our speaker. Enpo and the team of financial coaches that he oversees work with over 400 plus medical families, providing unbiased, personalized financial advice and planning, guiding clients to their ideal retirement and helping them choose the best, most efficient strategies to grow and protect their wealth. As Masters of Science in Financial Services and many licensed designation, he is a CFP professional. He is featured in the American Association of Physician Leadership's Medical Journal with a piece on how to hire a financial advisor, with additional publications in the works to be released very soon. Welcome, Enpo Tu. Thank you.
All right, and then just as a quick disclaimer, to put that out there, letting everyone know that this is being brought as for Memorial Hermann, just based off of a survey that was sent out a while back, just asking, hey, what are some financial topics that you all may be interested in? We are in no way endorsed by Memorial Hermann as a go-to offering or anything of that nature. Instead, there is compensation that we receive from Memorial Hermann to bring this educational offering to everyone here. And then as a personal note, Dr. Khaled did always mention at the end that he is a client of ours, but he is of course not receiving any compensation from us or anything of that nature to bring this offering to you all. So with that out of the way, thank you everyone for joining us today. I'm really excited to introduce myself. As you can see, Katya gave a little bit of background, but other than that, just wanted to add that I actually work with a lot of doctors and highly compensated medical professionals. And I think that oftentimes we tend to overcomplicate things. And I think that if you were to think, the most important things are pretty simple. And if you can boil it down to its roots, I think you can end up finding a very easy decision making framework, especially when it comes to investments. And that's really what we want to talk about today. So, of course, I do have my educational background in this topic, but I think really what everyone here is going to enjoy is that I've had the privilege and opportunity to talk with so many smart physician families, and they've actually given me a lot to think about of as, hey, what exactly is the most successful uh, financial strategies that they've employed, and what are those that maybe are not as efficient? So really, let's go into the objectives for today. So a lot of the times you're getting a lot of data points in front of you all the time. When you think about any investment, sometimes it could be a close family friend, it could be someone randomly emailing you, texting you, cold calling you, although I think it might be just AI now doing that. But when you get that solicitation, what should you consider? What are the things that are most important? Because it's possible that you could go out there on the internet and look for things. Do your own research, is what has been told. I've been very hesitant to say that that's research. It's just you're finding out who has the best search engine optimization. But now with AI and all that sort of stuff, you could really tailor things to your specific scenario. But once you do tailor that information, it's really hard to discern, hey, is this a good investment for me? What are some of the things I need to look out for? And how do I even decide any of this? Well, let's go back to basics. I'm going to help you out here to figure out, hey, what are some of the things that you need to focus on versus what are just nice to know or legalese that it's just really difficult to decipher. also want to go into how, hey, there's a lot of times where people tell you that they've made so much money doing real estate, stocks, cryptocurrencies, whatever have you. Why is it that other people seem to be able to make money, and why is it that I never seem to be able to make any money? Let's try to figure out, well, why are we maybe not getting the same results as other people? Also, as a doctor investor, I think that it's very good to think about, hey, what are speculations? What's gambling? How do I control my variables so that I can at least get the best possible results that I can get for myself given my situation? So really, that's what we hope to accomplish today. Really excited to get into the topic. I promise it gets more and more interesting. Uh, but let's start with the basics. A lot of the time, I think a lot of our clients that we work with have trouble with understanding holdings versus form of holdings. And that's very important because people will say, okay, I'm buying rental properties, or I'm putting money in my 403b, 401k, I'm opening up a traditional IRA, and I have stocks, bonds, cryptocurrencies, etc. What is oftentimes missing is a conversation around how you are holding these assets versus the actual assets themselves. So let's boil it down to what holdings are versus form of holdings. So a holding would be things such as stocks, bonds, ETFs, real estate, mutual funds, crypto wallets, or what have you. This is how you are uh, investing. That is the thing you're investing in. That is the actual thing that is being purchased. Versus form of holdings, that's going to be in taxable accounts, that's going to be in Roth accounts, that's going to be in your 403b, IRAs, or potentially just physical holdings. So you have some gold bars, you put them in a vault. That's also a holding form. And what's important is that your rate of return on your holdings is going to have an effect based off of the form of holding as well. And there's actually a very interesting interplay between all this. So I'm going to help you all explore this in more detail because I think that once you get this concept solid, you'll make better financial and investing decisions. Because the moment that you can think about, well, if I buy stocks, where should I buy stocks? Or I want to buy real estate. Where should I buy real estate? And how should I hold it? I think that helps you get 50% of the way there. So let's zero in on why even bother with all this stuff. Well, very simple answer: taxes. Whenever anyone calculates out their rate of return, they very, very rarely consider their net return. And I know this because oftentimes they don't know the cost of buying things, their expense ratios, and all of that stuff. But definitely something that's even harder to calculate are your taxes. So depending on how you are holding your assets, you will generate all sorts of taxes, either initially, eventually, or just in perpetuity. And that's why the form that you hold your investments in is super important. So let's go into, hey, what sort of taxes are you talking about here? Well, pull out your paycheck or your pay stub, and the first thing you're going to notice is that despite Uncle Sam not working those shifts with you, they get their cut right away. It's the federal income tax. And you're going to notice it on any of your W-2 that you're receiving. It's going to say, hey, this activity that you're doing, which is working, that's going to generate income taxes. But you know what else generates income taxes? Your bank accounts, your CDs, your bond accounts that are not tax protected. That's going to generate income taxes as well. And that's where, if you look at these tax brackets on the right, it's going to fall in one of these ranges. So let's say you get $100 from the bank, but you're in the 37% tax bracket. Well, you're not really getting $100. You have to calculate in, well, I think I'm only getting 63. Now, for those living in Texas, of course, you don't have to worry about state tax, but for later on when you move and you're taking income other places, you may have to consider that as well. Short-term capital gains also really bad. So let's say you buy a stock, you sell it. Well, that's going to cause you and you don't hold it for more than a year. That's going to trigger what are known as short-term capital gains, which are also taxed at income. So same bracket, same calculation. But let's say you hold it for more than a year. Long-term capital gains. Well, if you look at the bottom right, you'll see that there's a bracket range for that as well. And it can be as high as 20% for your long-term capital gains. Certainly not as bad as 37, certainly not as good as 0. Then you have your K1 distributions. That's for anyone who has the fortune of owning limited partnerships. There's certain rules around that. It can distribute gains or losses, but it's going to filter into one of these sleeves. It's either going to be considered income, which is going to be the top, or long-term capital gains, the bottom. Certainly, people have engaged in tax loss harvesting in certain accounts, which allow you to offset losses with gains and gains with losses. You can certainly pass your losses along. You can, in fact, let's say you trade stocks and unfortunately you didn't do so well, you can deduct up to $3,000 of that against your active income. If you buy your home and then you decide to rent it out, possibly you can depreciate it as well. So there's a lot of different things that you can do based on how you hold that asset. Because if you, by some reason, decide to put in real estate into an IRA, you're not going to get as much of that depreciation on your own tax forms as you'd want. In fact, it'd be distributed as income. So just thinking about, well, why should I hold this? Well, that's why there is something you can control. To be better at investing, you can try to control what your effective tax that you pay on your investments are. And if you think about it, you can get 100% rate of return. That's astounding. But if you're at 37% tax bracket, that's immediately going to cut into your real rate of return unless you understand what form you want to hold that investment. So I think I'd like to share with everyone a very good way of how to think about this. And we're gonna have a little bit of fun here. Instead of going into more charts and graphs and numbers, I'm gonna use an analogy, and I think it's helpful because you're on course. You're on course for retirement island. You want to make sure that you are getting towards all of your goals, and you want to make sure that you're, for lack of a better word, enjoying smooth sailing. You're heading over, and you want to get there as soon as possible. But there's a problem. When you set sail for retirement island, it's dangerous. You got to figure out, okay, well, I'm on this ship, and there's all sorts of things that could happen. We could have a leaky boat. There could be dangers of the sea, or the most dangerous of all, there could be other people that want your stuff. So let's talk about that. So let's say that you have a after-tax taxable later account. This is your default holding option. So if you open up a Robinhood account, or if you open up a Vanguard account, Fidelity account, and you don't put any protective tax wrapper around it, your default is going to be after-tax taxable later. This is also what happens if you hold real estate. It's also after-tax taxable later. There's also, if you were to buy gold bars or anything along those lines, same deal. So the IRS is the pirate guy over here. And what happens when you have an after-tax taxable later account is the IRS steps in and they say, hey, this is a nice money you have. In order for you to do any of this, we're going to want our cut first. So you think about it, your paycheck, right away, money comes out of your paycheck, goes to the IRS. Whatever is left goes into your checking account. That's the initial tax hit. That's where the IRS shows up. They take the money. Okay. So you got all this money and you got to think, okay, well, I want to make a rate of return on this. So you take this after tax dollar and you go, well, let me try buying some stocks. So you take that money and you put it into an after tax taxable later brokerage account. Now, the thing about this boat, as you can see when you initially put it in, is the moment you put the money in, it starts leaking. Why is it leaking? Well, it's because depending on what you've bought, it's going to spit out income, it's going to spit out long-term capital gains, and all of it is going to slowly lower your rate of return all throughout your journey. Now, let's say you get to your destination. You start, I mean, it's grown a lot. You can see the money's grown a lot. It's still leaking, but it's grown a lot. All right, now you want to start taking your money. Well, the IRS shows up again and they say, hey, it's a nice appreciated stock you have there. It would be a shame if we asked you to pay taxes on all that gain. And you go, okay, well, looks like I have to do that. And so as you are taking your gains, you will have to probably pay long-term capital gains. And if you've held it for under a year, same deal. They're going to take their amount as well. And going back, that could be as high as 37%. All right, so that's the default option. You don't do any tax protection at all. That is your default setting. Okay, so let's add a little bit of complexity here. So you go, well, you know what I want to do? I don't want my boat to leak. Instead, what I want to do is I want something where when I take my money, I don't want to keep having issues where I'm having to constantly pay taxes all throughout. So same scenario. You get your paycheck, the IRS takes their money, it gets deposited in your checking account, but you're smart. You've thought about it. It's like, well, I don't want a taxable brokerage account. That's just going to make it so that I have to keep paying taxes all throughout. And I think I can keep more of my money if I'm not paying taxes all throughout. So let's say you bought some municipal bonds. Now, municipal bonds are bonds that your local county or whatnot, they go ahead and they write these bonds, and as they're growing and spitting out money, they're tax free to you, and you don't have to worry about paying taxes on those. Uh, and then in the future, if let's say they appreciate and you sell it, well, now if there's a gain, that's when the IRS shows up and takes the gain. But all throughout, you're protected from it leaking. Another form that you can hold this is annuities. Annuities make it so that you're not paying taxes as it grows, but when you take it out, you have to start paying taxes, usually on a first in, first out. Or sorry, last in, first out sort of deal. But some annuity companies have kind of figured out a workaround with the IRS's blessing where you can take equal amounts if you annuitize. But just know that this is perhaps one step above, where you are now able to not have to pay taxes throughout. And that may help with your rate of return. But that is just the holding form. Okay, that's just the form of the holding. So now there's after tax, tax-free later. So same scenario, you get your paycheck and the IRS takes their cut. But let's say your employer offers you a Roth 401k option. Okay, so the IRS still gets their money, but now you can take your money from your paycheck directly and put it into a Roth 401k account. And this holding allows you to not have any taxes taken out as it's growing. And then what ends up happening is as you retire, or when you retire and you start taking money out, the IRS doesn't show up to take any of your gain. Now, there's the other way around too, which is pre-tax, gross tax-free, but is taxable later. And that's where same scenario where you're getting paid by your employer, but instead of paying taxes now, the IRS isn't there. You ask your employer to just put it into this 401k account, this pre-tax 401k, and it gets to grow tax-free. However, the IRS shows up later to take the money from you. All right. So I'm sure that none of this is surprising to most people that have maybe looked at financial content before. They kind of already know this inherently, but I think the visual helps. But let's go a layer deeper. I think that's important because what we want to do is we want to invest. We don't want to just know that I have 403bs, 401ks, taxable brokerages. I need to do something with the money inside. Okay, so let's talk about what the most important considerations are when you are trying to put things into these buckets, these boats. Okay. First thing is tax implications. If you have something that's really heavy, that's going to weigh down your ship, you better hope that you have something that isn't going to leak taxes all over the place and sink your boat and make it harder to get to the place you want to go. Now, of course, there's rate of return. Hey, how much money can I expect to get for this stuff? And then there's expenses, which we'll talk about that. There's direct and indirect. And then there's liquidity and marketability. How easy is it for me to turn what I have into cash money? All right, so we're getting ready to sail for Retirement Island. But before we set sail for Retirement Island, what do we got to do? We got to go buy some stuff. So here we are, we're in the marketplace of ideas, and we need to think, okay, what do I want to buy? Well, let's start with your very plain Jane vanilla thing that most people think about when they think investments. I would say stocks, bonds, ETFs, mutual funds, brokerage assets, if you will. Now, when it comes to what sort of tax implications your brokerage assets may have. It's all over the place. I mean, I brought up muni bonds. You can kind of hold it, and that's not really a form, but there are certain T-bills and whatnot that are being held. But I will say this: this is more of a holding that you can have. There is stocks where you can probably expect to pay long-term capital gains. There may be qualified dividends that you eventually receive, short-term cap. There's all sorts of things that you can have. And so I would say it's almost like fruit. Lots of different types of fruit. You get to choose all of it, and there's all sorts of rates of return. But thinking about it, just a 60-40 portfolio from Vanguard, it's about 6.8%. That's like mentally, that's probably about what you can expect for a rate of return if you're investing moderately aggressively, too aggressively. And the expenses, I mean, there are lots of 0% cost ETFs. I believe that Fidelity, for example, has a fund that does that, all the way to many actively managed funds, which could be in the 2% range. But of course, the expenses are very wide. There's also the possibility that if you're buying stocks, there's a lot of times where you buy very thinly traded stocks where it's just really hard to find someone to buy and sell your stock. Think GoPro in a few years. If that company goes bankrupt or getting closer to there, it's going to be hard to find someone to buy your shares. But if you buy the S&P 500 ETF, there's going to be lots of people buying that all the time. So that's where, when you think about your brokerage type assets, Think of it as fruit. You got to pick and choose. Sometimes fruit goes rotten faster. Sometimes fruit can make a very long journey. And really, you may even want some of this fruit to eat along the way. So that's where brokerage assets are pretty helpful because usually they're a little bit more liquid, and of course you can choose what fruit you want to bring on with you. All right. So let's talk rental properties. Everyone's favorite asset class, passive income, be your own boss, and actively retire faster. Now, don't get me wrong. I think all of that is possible. However, we need to think about why people buy rental properties. And I think it's pretty easy. It tells a good story. The good story is it helps you save on taxes. If you hold it and it's physical, you can look at it. And then there's all those stories about how there were many boomers back in the day who, for some pocket lint and 2 quarters, were able to buy a nice property that is now worth $1 million. And I'm sure that you probably know some of these stories, and that's fine. But I think what we miss when we think about these stories is that you have to hold it. And that's hard. It may have initially cost 2 quarters and pennies and some pocket lint, but in order to hold it, that means that you have to pay property taxes. You have to fix things when they break. You have to do all sorts of stuff. So if you were to think about what sort of tax implications, well, there's property tax right away. But there's also, let's say you rent it out. Well, now there's income that you got to pay. You got to pay income taxes. Okay, that's not great. Now there are some ways that you can mitigate that potentially by doing depreciation or taking some sort of deduction on the mortgage. But you have to remember that you are going to have to pay those income taxes unless you can mitigate them. And then eventually, when you sell it, long-term capital gains. And if you depreciated it, also income, because you need to recapture that. Now, according to Investopedia, you can expect a 5.5% rate of return. That's great. What's not great is, well, when you buy it, you got to have a 6% commission in, and I would say probably a 6% rate of commission out. I know that you can always negotiate, someone pays the fee, you don't pay. Just presume that you might have to pay the fee in and out. Also, there's your carrying costs. I alluded to some of that earlier, where you have to fix the roof, and if there's pipes, you gotta fix it as well. Um, and that's what I would consider a capital call, where essentially you got to spend money to make money in this case. And I would say, in terms of marketability, liquidity, whenever anyone says it's a hot market, they're probably saying, hey, within a few hours or a few weeks to get the right price, you can sell it. However, if you're in a cold market, I mean, you could be months, up to years sometimes, to find the right buyer, especially if you have property that becomes undesirable. And if you think about it, people that were buying homes in Detroit are probably not having a great time trying to get their home value back up. So it is one of those things where the buyer must beware. And the thing that I would compare it to is livestock, specifically cows. When you buy a cow, it's definitely more expensive than fruit, and all throughout you're getting milk from it in this case, so income, and that's its own blessing and curse because of the tax implications. And you have to think that there's a commission that needs to be paid when you buy and sell livestock, because there's a professional that needs to look at the teeth of the cow, make sure that it's the right age, make sure it produces milk. Livestock is a lot more risk, so you got to make sure that you take care of it as well. So that's where I would probably put rental properties in the back of your mind. Think of it as livestock. All right, now let's talk private equity. Probably some or all of you are accredited investors, which means that you make enough money where you get to choose whatever you want to buy. It could be private placements, IPOs, your cousin Vinny's pizza shop. All of these are examples of private equity that you can invest in. Now, I'm not going to get into the tax implications of private equity because there are some private equity that is specifically there to try to generate a huge amount of losses for you. And there are some that just want to generate a huge amount of gains. Uh, so let's put that on the shelf for now. But why do people buy this private equity? Well, according to Investopedia, it's because the rate of return seems kind of nice at 10%. Would you believe that? Uh, could 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 be pretty high reward. However, there are costs. There are costs to investing. Uh, it's free if you invest in your cousin's restaurant. They're willing to waive the fees. However, you pay in headaches. But then there are plenty of people that put money in hedge funds, which usually have a 2 and 20 structure where they charge you 2% just for your money to exist in it and 20% of any of their gains and performance. Uh, some variations of those exist as well, of course, but that's usually when people think of private equity, they think of hedge funds, and that's usually how they charge. Liquidity, ouch. Okay, so there was a company, or is a company, called Blackstone. Oftentimes, very much a punching bag for pundits and TV personalities alike. But they have a fund that buys and sells and holds real estate. Uh, it was considered one of the more liquid funds, but then Blackstone froze redemptions. Uh-oh, what does that mean? What that means is you can't get your money out. And so there are lots of times where private equity can say, nope, you don't get it. Sorry. We need to lock up the money so that way we as a group don't suffer losses. But what that means for you is your money doesn't exist anymore. Same for your cousin's restaurant. I mean, how are they going to pay you back for your initial investment? It's a good question. They might be able to finance it from a bank, or they may be able to generate enough cash, very rarely the case, or you sell it to someone else. And there are plenty of people who buy private equity where there will be a third party that steps in and offers to buy it off of you. So, so I, of course, less than what the face value is or how much you put in, oftentimes. So the way I describe it is it's like an exotic animal. I mean, think tigers, think toucans or something like that. It's could potentially be very expensive to upkeep. Uh, you don't know what the value is when it shows up. It could die on you. I mean, you don't know how to take care of a tiger, most likely. So it could die. It could die on the trip there. It's possible. Uh, it's not guaranteed that your tiger is going to make it by the time you get to retirement. So let's put it all together. I think I think that what we need to do is we need to put everything together because you're holding things in a form, but you're still holding the things. So let's talk about the most common thing that people do. They open up a Robinhood account, they open up a Fidelity account, and they put stocks, bonds, ETFs into this account. In this case, you are putting the fruit into this wooden boat. So it is leaking. Now, what will end up happening is your fruit, depending on what type of fruit you put in, could spoil faster, it could spoil later. But if you are efficient with it, you could probably get fruit that's going to make the journey. It's going to make the journey because you've chosen fruit that won't spoil so fast. But let's say you actually are making a very short trip and you want to eat the fruit. Well, potentially it won't matter as much, but you're definitely going to watch out because anything you put into this boat is going to start leaking. It's going to start leaking right away. So you got to think about, well, what fruit, especially if you're going with brokerage assets, what fruit can I buy that won't leak all the time, or at least will be small leaks? All right. This one's maybe a, a little bit more nuanced, which is a NIMCRUT with private equity. All right. So what do I mean by this? All right. So let's say you end up buying a rental or a some sort of private equity thing. Let's say it's really really nice. Um, it's just a really nice partnership. You and all of the other doctors in your medical practice buy the rental property that you all practice out of. It's a commercial thing. So you all get together, you buy the building. All right. So what money did you use to buy that property? Well, it's probably going to be with your after tax paycheck dollars. So the IRS is stepping in, taking your money. All right. But then you take that money and you put it into this charitable remainder uni trust by taking your assets that you purchased, um, this real estate uh, plan that you have with all your fellow doctors, and you put it into this charitable remainder uni trust. All right, while it's there, it's a charity, so it doesn't pay any taxes, doesn't pay anything while it's in there. And then what happens is when you sell it, the idea is that charities still don't pay taxes. Now, at some point though, when you take the money out, well, now you got to find something else to put it in. Let's say it's a taxable brokerage. Well, the IRS is still going to show up and they're going to want your money. So, as you're taking the money out from this charitable remainder trust, uh, but it got to sit there without taxes and grow without taxes in the meantime. But when you do take it out, you do have to pay taxes on it. Now, let's say you have a Roth 401k with a brokerage asset, which is, for all intents and purposes, just your Roth 401k. It's not a true brokerage because you can't buy anything other than what your employer has decided for you, but they give you enough oftentimes to make your own portfolio. There's usually some sort of S&P 500 fund. There's some sort of international fund, and you just kind of choose your own adventure. Uh, but same thing, the IRS is going to show up, take your money. You use that money to buy brokerage assets, and so you are able to pick and choose. But here's the thing: no leaking, so you don't have to worry about uh, the taxable implications. You just want to grow that as big as you can, and that's really interesting because when you're thinking of Roth 401k, hey, I've already lost my pound of flesh, so let me really try to grow this. The person that comes to mind that took this to the extreme was Peter Thiel, who bought his private company at the time called Palantir and stuffed that into his Roth somehow. Um, I think he's still fighting it out with the IRS, but he's got all this money because his Palantir shares eventually became very, very expensive. Um, but that's something to consider when you're thinking about, okay, Roth accounts. Now, let's say you open up a self-directed IRA with a rental property. Okay. So this is something that I don't know if many people have heard of, but I've seen a handful of companies market towards physicians this idea that, hey, after you retire, instead of putting your money in the stock market, why don't you put it in the property market? And how you do that is you open up, you take your 401k money and you put it into a self directed IRA. And then from there, you create a business that owns rental properties. And you take that money and you buy rental properties with it. You get a loan from it. And it's, hey, you own a rental property. All right. Good news. No tax leaking. So that helps. We all know that rental properties, it leaks taxes in the form of income. However, any money that comes out of that, that's always going to be taxed by the IRS as income. So just remember that. And you need to sell that self-directed IRA at some point or the assets inside of them because you have to satisfy your required minimum distributions once you hit 70s. So just remember that. These are strategies that exist, and it comes with a form plus a holding. The form is the self-directed IRA. The holding would then be the rental income. And some people have done this with franchise businesses as well. So let's put this all together even more. So the surprise here is that you're actually not limited to just one ship. You could have many ships. You could have maybe one ship with everything put into it, or perhaps you could have many, many different ships with many different things put into it. You can have a taxable brokerage with stocks. You could have a self-directed IRA with private equity. You could do all sorts of things. But the important thing is you need to think, hey, where am I going? Where's my destination? How far do I need to get there? What do I need along the way? And that's going to help you choose what assets to buy as well as where to put your assets. So that way you're not having that tax drag along the way and you're more efficiently investing. And this is so vital for my physician clients because they're always surprised that people that make less money than them do so well with real estate, but they don't. And it's very shocking because they don't realize that the people that are doing much better than them at real estate or some of these other things don't have as heavy of a tax drag as you do. And so that's something that you always have to consider when you're making any investment. It's great that you won the super investment lottery and you bought Palantir at, less than $10. But when you go to sell it, you might be facing something very different from someone else. So always remember that when you're going in here and you're looking at all of these assets as well as these forms that you're holding the assets in, that you are always going to want to be aware of the form as well as the investment type. All right. So now's the Q&A section. I'm going to answer questions for everyone who has them on the line. There is a QR code on here if you want to learn more about my financial coach and what we have done for all of our listeners here at Memorial Hermann. There's actually a bit of a discount for being part of Memorial Hermann. I know that you could go on here, scan the QR code, learn more about what I do for all of my clients as well as my colleagues, which is to help people figure out, hey, how do we enjoy the trip and chart out our destination for all of our clients. All right. So everyone, please feel free to put questions into the Q&A. However, I do see that we have one question on here already. Let's see, you have a 401k and wish to roll into a Roth 401k. How is that done in market downturn? Okay, well, oftentimes when you are in a 401k from your employer, uh, you have an option to contribute to a Roth. Some of them may allow you to convert to a Roth inside of your 401k, some may not. I would read what is known as your summary plan description, and all of your 401ks have that. And it will tell you exactly what you can and can't do inside of your 401k. Now, if you did decide, and this is something that you can do inside of your self, your IRAs, or let's say you have a Roth IRA as well. You can do that pretty simply. If you have an IRA open and a Roth IRA open, let's say your IRA tanks in value, well, what you can do is you can sell some of those assets and roll the cash over into your Roth IRA, or if it's with the same brokerage, sometimes you can just ask them to roll that and transfer the securities over, pay the taxes later on it. But just remember that what you are doing is you're still liable for the income taxes when you do that conversion. So even if the market does have a downturn, you still have to pay the taxes on the amount converted. And you probably want to hope that those assets rebound. Now, there are plenty of reasons to make rollover decisions, but I do caution, at least for a lot of the clients that we work with, oftentimes they are currently in their highest earning income years. So you're making anywhere from a quarter million all the way to a million plus, which could potentially put you in the 20s and 30s percentage of taxes that you're already paying. And when you do conversions during this time, you're adding that as income to the top. And what ends up happening is if you wait until after you retire and your income drops potentially, that's when making Roth conversions may cost you a little bit less percentage wise. Uh, but for those individuals who feel, hey, I'm just going to always have a lot of income through my rental properties or through my royalties that I get, that's not as big of a deal. And if you know that you're always going to pay pretty high taxes, then converting to Roth is something you should probably do as soon as you can. Let's see. At what point in time does permanent variable life insurance become balanced portfolio? Um, I think that when anyone buys any asset, I think they should probably think about why they're doing it. And I think that for some people, when they buy a taxable brokerage account or assets that are inside of a taxable brokerage account, they just want to make as much money as possible, and that's all they want to do with it. Potentially same for a Roth 401k. But there are also a lot of reasons why people will buy assets that are not necessarily return oriented. So I have a lot of physicians that I work with who will buy a medical building, even though the ROI for it is actually not that great. Or they're concerned that the demand for it is actually dropping, especially in the area that they work in. But sometimes it's tied to prestige, where amongst their colleagues, if they don't own part of the building, they feel lesser, or maybe there's some office politics involved where they kind of feel like they have to do it. And that's where I would say that there are alternative considerations to owning the asset other than rate of return. And when it comes time for life insurance, I would probably say that there's a lot of things that you can and can't do with it. But here's something that you can't do. You can't have everything. So if you do need to take cash out of it for whatever reason, that could adversely affect how much it pays out should you pass away. And I've heard it said that nothing is guaranteed other than death and taxes. It's interesting because we spent a lot of time today talking about taxes, and the question we get around life insurance has to deal with death. So I think it's a matter of balancing your priorities, because at some point when you pass away and you want to take care of your family, you may want to have a policy that protects them. And if it's permanent, that means that it could last indefinitely. But at the same time, if you're buying it for tax reasons and then using it to invest, I would say to pull what is known as an in force illustration at least once every 5 years. Now, for those of you who don't know what that is, an in force illustration is essentially you asking the insurance company, hey, how realistic were your projections when you first gave me this policy? And when you look at that, sometimes the numbers match what they initially quoted you, but sometimes they don't. Sometimes they look very, very bad, actually. And sometimes that's because the insurance company has raised the internal costs. There's actually a band that they're allowed to raise it. That could be one reason. It could be that your investments did not do as well as you thought inside of your insurance. And for all these reasons, until you pull that in force illustration, you won't know if it is doing what you think it's doing. And if you take money from something that's already kind of floundering, you may need to put even more money back into it in the future. But it all depends on how it's structured. I've certainly seen a lot of physicians walk in with interesting insurance policies. I always pull their in-force illustrations. I've actually done that for um, even some insurance people that work with us. They own brokerages, and they still sometimes overestimate. So in my role, I don't sell insurance, but I can read that document and translate it for my clients, and they really appreciate that. All right. Um, I think I think those were all the questions that I saw. Um, Katya, were there any additional questions that you saw on your end, or any closing notes that you wanted to add?
I have a comment in here that says, you may have gone over this already from Dr. Beam. At what point in time does term variable life insurance become balanced portfolio?
Yeah, I unfortunately kind of went on a tangent on that one. It was a long answer. The answer is pull your in-force illustrations and it'll tell you. For those of you that didn't get the nugget from my rambling.
And then there was another question about the 401k. It says, so you have 401k in which to roll it onto Roth 401k. How is that done in market downturn?
So when it comes time for the 401k, I answered that earlier as well. However, the way that I answered that was in the form of, well, you'd have to pull up your summary plan documents to see if you can do it within the 401k. If it were a IRA and Roth IRA, that would be a little easier, but just remember that you're paying taxes on it.
And so instead, I thought you recommended some form of life insurance in the first meeting.
Uh, from I think the first meeting was done with Bill, our CEO, and I think if you go back to the first webinar, you'll see that he says, "Hey, you got to be careful what you buy." Because there are some policies that aren't structured in the way that you think it is. And that's exactly what I reiterated. You need to pull, if you already bought it and someone told you to buy it, you need to pull your in-force illustrations to make sure that it matches. Because if it doesn't match, then unfortunately you may have been sold something that is not performing well, and you may need to consider either changing your policy internally, because you can fix it. You could lower to the death benefit, for example, or you can buy another policy with whatever you have inside of it. But just remember that when it comes to life insurance, it's a very complex policy. And so you want to review it occasionally. But if you think about it, lots of people look at their 401k every year. Very few people will pull their in-force illustration to look at their insurances, especially when they're trying to make money inside of it, which you certainly want to think about.
I don't see, oh, wait, one more comment. Can you please give an example of which type of policy you'll recommend?
The types of policies that I would recommend, boy. Well, the good news is that I am in what is known as financial primary care, which means I look at my client situation and I see what they already have. I read their financial charts and graphs, and I try to figure out whether or not they're financially healthy. When it comes time for specific recommendations, whether that's, hey, you should buy this mutual fund, this life insurance, what we do instead is we interview insurance agents and investment advisors. And we try to negotiate on behalf of all of our clients so that they get the best service and products at reasonable prices, or at least at market rates. And what we will do is we would then refer our clients to them in order to get the answers. That avoids me monetizing off of my financial advice, and I can remain as unbiased and unconflicted as possible. But I will tell you this: you need to, if you are looking to make money inside of an insurance policy, we would want you to speak with someone who specializes in those type of policies, and not just a general insurance agent who can sell you off the shelf products.
It does not look like we have any more questions or comments. Thank you so much. Thank you everyone for joining. This is the last of all the 3 webinars, and the recording will be made available for future listen. And we'll also be sending out a survey if you'd like to provide feedback. We would really appreciate that.
All right, everyone. Thank you.
Thank you.